So the first option strategy we're going to talk about is purchasing call options. These are a high-risk strategy, but they're an excellent way to make large gains very quickly if you're confident in your moves. Before we get started discussing the strategy, we're going to have a disclaimer. Before you go any further, you have to understand that call options are extremely risky. You can either multiply your initial investment by 10, or you can lose all of your investment. And by all of it, I mean literally 100% of the money you invest. So do not play with call options unless you are fully willing to lose 100% of your investment. Thanks, Mikey. And right from the top, I want to go ahead and thank Screencast-O-Matic for the free recorder, link in the description. Let's say there's a stock out there that you think is about to release some good news and the stock price is going to rocket up higher. Right now in October, the stock is trading for about $21, but you think that the company is about to make a big announcement and its stock price is going to go way up, probably above $25. Now, conventional wisdom might tell you, why don't you go ahead and buy some shares? You can get them right now for $21. You think it's going to go up above $25? Go ahead and sell it at $25 when it reaches that price, and you'll have made $4 on every 21 that you put in, which is about 19%. Most people would spend an entire year hoping to even get close to 19% profit. Why not just buy the shares? But if you're that confident, you can make 19% look like chump change by using a call option. When you purchase a call, you are buying a contract that allows you to purchase shares at a certain price, called a strike price, at or before a certain date in the future, which is called the expiration date. And for that opportunity, you must pay what is called a premium to the person who is selling the contract. The contract is always for 100 shares. So let's go back to our example. The stock is trading around 21 right now, and we think it's going to go up to at least $25, and most likely beyond that. So what we're going to do is buy a call option at a strike price of $25 that expires in November. And remember, what this is allowing us to do is purchase 100 shares per contract at the price of $25 at any time at or before the expiration date in November, so November 23rd. In order to have this privilege to buy 100 shares at $25 at any point at or before November 23rd, we must pay a premium to the person who is selling the contract. Remember, when he sells that contract, he's obligating himself to sell shares to us at $25 at or before that date. And if you're going to take on an obligation like that, you're expecting someone to pay you for it. And that is why we, as the purchasers of calls, must pay the premium. Let's say in this case that the premium for this contract is about $100. And for a stock that goes up and down as fast as the example we have here, I think that's a pretty realistic estimate. So let's expand a little bit on why we might want to choose calls instead of shares in this situation. In our example, one share of stock costs us $21. So if we apply just a little bit of math, we'll see that 100 shares of stock would cost us $2,100. So we can buy 100 shares for $2,100, or we can buy one contract which controls 100 shares. And we wouldn't have to spend $2,100 on it, we would only have to spend $100 on that contract. But now you've got an extra $2,000 laying around, so let's go in a lot deeper on this stock. You want to spend $2,100 on this bet. So let's go ahead now and not buy one contract for $100, but let's go ahead and buy 21 contracts for the same price as 100 shares, $2,100 for 21 contracts. And by holding those 21 contracts, we are now going to control 2,100 shares of stock. We spent the same $2,100, but now we own a lot more shares, so we can amplify our gains when the stock price increases. So for simplicity, let's continue our example, assuming that you only bought one contract for $100. Well, we like that deal. We think that sounds pretty good. So we're going to go ahead and buy our contract. We're going to pay the $100 premium, and we are going to wait for the stock to rise in price. Now, sometimes waiting can be the most difficult part of owning a contract, because you know that while you're waiting for that stock price to rise, that contract is becoming less and less valuable. When we purchased that contract, we had an entire month until the contract expired. Now, as the days tick by, we have fewer and fewer days until the contract expires. And if the stock doesn't move to where we think it does, we may end up finding out that our contract is useless. If the stock doesn't go up above $25, what good is having that contract? is below $25. So we're not going to take the opportunity to buy at that price. Instead, we're going to end up having to throw that contract out, and the entire $100 premium is wasted. Now, I hope watching this clock tick for the last minute has been painful, because when you're watching a stock waiting for it to rise while your contract becomes more and more useless, it can hurt really bad. So I hope this experience has hurt you enough that you can understand how painful owning calls can actually be. And that's enough of that. So we've waited very patiently. November has rolled around, and we were absolutely right. The stock has increased substantially. We have a whole new line up to $30 just showing where the stock has gone. We thought it would go above 25, and we were absolutely right. The stock has gone all the way up to $31. And our contract is good to purchase it way down at $25. We can purchase it for $6 less than what it's currently trading at because we bought this call. And remember, we only paid a premium of $100 for this call option back when the stock was still trading around $21. So let's think about this. We paid $100 for this contract, and this contract represents 100 shares. So essentially what we've done is paid a $1 per share premium to purchase this option. Now here we are 1 month later, and the stock is trading for $6 higher than the strike price. Previously, this call option only commanded a $1 per share premium, but now that the stock is trading for $6 higher than the strike price, this option now commands a premium of $6 per share. In other words, this contract that you paid $100 for is now worth $600. Now, when you think about it, that makes sense. I mean, the stock is trading for $6 higher. You have an opportunity to purchase 100 shares with this contract. So if you can purchase at 25 and immediately turn around and sell it at 31, it makes sense that this contract is worth $600. You bought this contract for $100. Now it's worth $600. That means that you multiplied your investment times 6. Getting returns like that just by buying stock would take forever, but we can see how using options can make that happen very quickly, sometimes within a matter of hours. Now, I caution you that sometimes people will see that large return and they say, well, if I did it with one contract and spent only $100, why don't I go ahead and buy 100 contracts for $10,000 and make an even bigger chunk of change? And yeah, sure, in this case, it would have worked out. You would have gone from $10,000 all the way up to $60,000. And here's an example of that. This guy doubled his money and he made $23,000 in one day. This guy here almost quadrupled his money. And then we look at another example right here where this guy bought for $11,200, sold for over $19,000, made $8,000 in a day. So can it be done? Yes, absolutely. But remember, it doesn't always work out that way. Remember when we bought that contract for $100 in premium when the stock was trading at 21? Well, let's look here. Look how much it went down. Do you think that contract is still going to be worth $100 when the stock goes down a couple of days later? It's not. That contract is going to be worth less because the stock has to increase by a larger amount before the contract is worth anything. So let's say it's only worth about now maybe $20. You spent $100, it's now worth $20. You suffered an 80% loss in just a couple of days because that stock went down. And if you thought you were smart and you wanted to buy 100 contracts, that $10,000 when the stock went down is now worth only $2,000, and you've lost $8,000. Not $80,000, $8,000. Do you have the stomach to hold on when you see yourself losing 80% in a couple of days? Not everybody does. And a lot of times you wind up suffering massive losses when things like that happen. And let's look at one example right here. So this guy here thought he was smart. He was playing options. He lost $10,000 in one day. And then after the market closed, some bad news came out about the company. And he lost another over $20,000 after the market closed, and he couldn't even do anything to sell his position. So he wound up actually losing more money than he started to trade with. I don't know what happened to him, but this is what can happen to you if you're not careful. So in conclusion, we want to make sure that we're taking calculated risks when we purchase our call options, but we see that if done correctly, you can wind up with some really massive gains. So don't be afraid to take an opportunity when you're confident about a move, but do not put all of your money into it. Do not do that, or you are liable to lose everything. On the flip side, if you trade options well, you purchase calls intelligently, and you don't take too much risk, you can make a lot of money very quickly. So best of luck to everybody. Happy trading. I'll see you in the next video when we're going to talk about the opposite of this. We're going to talk about put options.